Sri Lanka and China have taken yet another major step towards economic cooperation. In a landmark deal, Sri Lanka has secured a record-breaking $3.7 billion foreign direct investment with Sinopec, a Chinese state-run oil giant. Announced during President Anura Kumara Dissanayake's state visit to China, this deal is being hailed as a turning point for the island nation's economy. But as the excitement builds, so do the questions. Is this a strategic boost for Sri Lanka or a step deeper into China's controversial debt trap? During his visit, President Dissanayake and President Xi Jinping vowed to strengthen bilateral ties and deepen Belt and Road cooperation. The centerpiece of this collaboration? Well, a state-of-the-art oil refinery in Hambantota capable of processing 200,000 barrels daily. Dissanayake's visit to his country's largest bilateral lender comes after first traveling to India. He had won a big majority in September's election, pledging to tweak the terms of an International Monetary Fund rescue package and on his leftist coalition's plans to fight poverty and corruption. Sri Lanka had been moving closer to China under the previous Rajapaksa government, leaning heavily on Chinese lending to build highways, a port, an airport, and a coal power plant as part of Xi's flagship cross-continent Belt and Road infrastructure initiative. This ambitious deal is expected to generate jobs, bolster exports, and uplift the local economy, especially in the southern Hambantota region. Interestingly, this refinery will be located near the Hambantota port, a key maritime hub already under Chinese control through a 99-year lease signed in 2017. Well, the port was handed to a Beijing company on a 99-year lease for $1.12 billion in 2017 after Sri Lanka was unable to repay a huge Chinese loan, a controversial decision which raised questions about Chinese investments in the country. Sri Lanka also defaulted on its foreign borrowings in 2022 during a crisis that caused months of food, fuel, and medicine shortages. While the port's lease was initially touted as a solution to Sri Lanka's mounting debt, it sparked widespread concern, symbolizing what critics call China's debt trap diplomacy. The devastating crash of 2022 led to a sovereign default, crippling its economy. At the time, more than half of Sri Lanka's bilateral debt was owed to China. Today, China's involvement remains significant, from restructuring loans to extending fresh investments. Supporters argue that this deal signals a shift, prioritizing foreign investments over loans to rebuild the nation's economy. The Sinopec project is also expected to strengthen Sri Lanka's foreign exchange reserves by allocating a substantial portion of its output for export. But history offers cautionary tales. From Djibouti to Zambia to Pakistan, China's investments have often come with high stakes. For example, Pakistan's Gwadar port is more of a Chinese outpost than a local economic engine. With its strategic location along vital shipping routes, Sri Lanka's assets are undeniably attractive. But as the nation embraces China's investments, it must carefully navigate the fine line between development and dependency. Will the $3.7 billion deal mark a new era of prosperity for Sri Lanka, or is it yet another chapter in the unfolding saga of China's influence in the region? Only time will tell. For more news and updates, keep watching Live Mint.